You built a business to create a better life for yourself, but do you actually know how to pay yourself correctly? This is one of the questions I get most often from small business owners, and the answer depends on how your business is structured. Getting this wrong has real consequences: unnecessary taxes, IRS scrutiny, and money leaving your business in ways that could have been avoided. Let's walk through exactly how this works. If you are a sole proprietor or a single member LLC that has not elected S Corp tax status, you pay yourself through what is called an owner's draw. An owner's draw is exactly what it sounds like. You transfer money from your business account to your personal account. There is no payroll involved, no W-2, you just move the money. The important thing to understand is that you pay taxes on your business's net profit, not on what you draw. So even if you draw $2,000 from a business that made $80,000 in profit, you owe taxes on all $80,000. This surprised a lot of new business owners. You cannot reduce your tax bill by simply not drawing much money out. The Profit First system handles this naturally. Your owner's pay account gets funded with every deposit. You pay yourself on a schedule, and the tax account is already being funded separately so that the bill is never a surprise. Now let's talk about S corporations, because this is where the tax strategy gets interesting. If your LLC has elected S Corp tax status, or you have an actual S Corp, the rules change. You are now required to pay yourself a reasonable salary as a W-2 employee of your own company. Here is why this matters. When you are a sole proprietor, all of your net profit is subject to self-employment tax. That is about 15.3% on top of your income tax. It covers Social Security and Medicaid. As an S Corp, you only pay your self-employment tax on your W-2 salary. Any additional distributions you take above your salary are not subjected to that 15.3%. So if your business makes $150,000 and you pay yourself a reasonable salary of $75,000, you only pay self-employment tax on the $75,000. The remaining $75,000 comes out as a distribution. The difference can be tens of thousands of dollars a year in savings depending on your situation. The catch is that your salary has to be reasonable. The IRS is watching for business owners who pay themselves $1 a year to avoid payroll taxes. There are guidelines for what reasonable means in your industry, and you should work with a tax professional to set it correctly. If you run a partnership, you and your partners pay yourselves through guaranteed payments or distributions. Guaranteed payments are similar to a salary and are deductible by the partnership. Distributions are a share of the profits. Partners are generally subject to self-employment tax on their guaranteed payments and their share of the partnership income from active business activities. Partnership tax is its own world, and getting it right is worth the investment of working with someone who knows it well. Regardless of your entity type, one of the best things you can do is pay yourself on a consistent schedule. A lot of business owners pull money out whenever they need it. When things are good, they spend freely. When things get tight, they take nothing. That inconsistency makes it almost impossible to plan your personal finances, and it makes your business financials harder to read. Profit First solves this by funding your owner's pay account with every deposit. Then you pay yourself twice a month from that account, same as any other employee would be paid. When your personal income is predictable, your personal life is more stable, and a stable personal life makes you a better, less stressed business owner. This is the question everyone really wants answered, and the honest answer is that it depends. It depends on your revenue, your operating expenses, your growth goals, and your personal financial needs. What I can tell you is that not paying yourself, or paying yourself an amount that does not cover your actual living expenses, is not a sustainable strategy. It leads to burnout and resentment, and it often means the business is not as healthy as it needs to be. Use the Profit First owner pay allocations as your starting point. Then work with your bookkeeper to adjust it based on where your business actually is. Getting your compensations right is not just a tax question, it's a business health question. At Benchmark Ledger Solutions, we help business owners understand how to structure their pay in a way that is both tax effective and sustainable for their business and their personal life. A profitable business is not at odds with doing good. It is what makes doing good possible. That starts with making sure that the person who builds the business is actually being paid fairly for their work. Visit benchmarkledgersolutions.com to book a free consultation. We care about your profit first, always.